Hello, everyone, and happy 50th anniversary of the meeting of the Dakotas conference in Bismarck, North Dakota. My understanding of the city, Bismarck, which I have not visited, but certainly a recognizable name, is that when America Frontier was fairly empty, they wanted many new people to settle in this vast empty space. And by putting a German name, Bismarck, they hope to draw many German immigrants into the region. So I'm not sure if some of you in the audience have a German background, but nonetheless, America the Beautiful, and I'm glad that you are holding the meeting in the North Dakota. Now, for the reason why I'm here is that you invited me to give some economic update, and certainly the market has changed. It is no longer the frenzy condition, the low interest rate environment of the past 2 years. In fact, we are knocking on the door of 6% mortgage rate. And this doubling in mortgage rate is really leading to some buyers simply unable to qualify for a mortgage. I do believe that there is still a strong desire to buy. It is really about affordability challenges and the financial capacity. So in this environment, what can you anticipate? All this part, I'm going to put it on a PowerPoint slide. So let me upload that onto the screen. So bear with me for 1 second. There we go. So I believe that you can see it on the slide, and this is a recording, so I hope everything runs well, because otherwise I have to do take 2. And so hopefully you can see it on the screen, hear me all okay. So let's first turn to the economy. Economy experienced 2 straight quarters of GDP decline, as you can see on the chart. It is relatively minor decline compared to the whiplash that we saw in the early months of the COVID, the beginning of the chart when the GDP completely collapsed, followed by a reasonable recovery. Then we was on a positive territory, growth, before turning negative from the beginning of the year, 2 straight quarters. Now, when I took Econ 101 course, just common sense, and what professor explained is, yes, simple rule of thumb on real time is 2 straight quarters of a decline is a recession. But believe it or not, there is an official committee who will determine whether or not we were actually in a recession, probably 1 year from now. By that time, everything would have changed, but they will announce whether we had a recession or not. So, but anyway, economy is struggling at the moment, as you can see on the 2 straight quarters of a production decline. But if this is a recession, it would be the most unusual recession of all time. I have never seen anything like it. In terms of, we have more job openings, as reflected in the blue line, compared to people who are unemployed and searching for jobs. If you are just sitting at home on couch, sleeping all the time, then you are not part of this statistics. But if you are searching for a job, because to be unemployed, one has to be searching for a job, this shows that in America, we have more job openings than number of people searching for a job. Now, we do have little downward figure on labor force participation. Some people say stimulus package was a little large. It's disincentivizing work environment. In some cases, people took early retirement, particularly in the airline industry. So when the airline, they panicked and they saw no one will fly anymore, they essentially bought out pilots, flight attendants, baggage handlers to say, take early retirement, and they did. And hence right now with the aviation industry returning back to normal, well, they don't have sufficient number of workers. So we are in a very bizarre recession at the moment where jobs are plentiful in a sense, yet overall production activity is down. Now, this is the overall figures because we know that, for example, the oil drilling activity has not been very active, and certainly that's very important for North Dakota. And hence, people who are in the drilling industry certainly do not want to take on job at 7-Eleven or at a restaurant. They are looking for, the similar paying job. And so hence, there is some degree of job mismatch regarding what is available versus people who are searching for jobs. Now, if we look at 50 states, and I think many of you who participate at NAR events or attend NAR conference, you may have seen this graph before, but every month is updated data. So you are getting fresh data. And what this shows is that North Dakota is showing minus 2.6, while South Dakota is showing plus 2.2. I hope people in the back can see the figures, but if you don't see the figures, what it means is that blue collar states, a blue collar state is showing more jobs today compared to pre-COVID. South Dakota, 2.2% more jobs now compared to March 2020. While North Dakota is down 2.6% compared to pre-COVID days. So there is some variation. Generally speaking, Rocky Mountain states and the southern states are doing well. I mean, South Dakota is doing well, but also like Idaho and Montana. But states that was a little late in reopening its economy, like New York, Michigan, Pennsylvania, they're down. And another state that is down is oil-producing states. So you look at North Dakota, Wyoming is down, Louisiana is down, and Alaska is down. Because many oil companies, even with record high profits, are saying, I'm not sure how much drilling we want to do, because everything that's coming out of Washington policymakers is to say, less bankrupt oil companies. We don't need carbon energy, we need green energy. And of course, the reality is that green energy is important, but it makes up such a small percentage, we really need carbon energy. But if the oil companies are afraid of Washington or just saying prudent decision, why invest if the Washington will essentially take that away? So oil companies becoming very cautious and hurting the oil producing states. Now, if one looks at the job market of North Dakota and South Dakota, here, what you see is, so just on the color is that the South Dakota is red and North Dakota is blue, just arbitrary coloring of it. So South Dakota always had a little more jobs than North Dakota until the oil price boom from 2010 all the way to about 2016. So there was an oil boom in North Dakota, then little decline, and then both states encountered COVID, so lockdown essentially crashed jobs, but trying to recover with South Dakota in red, essentially setting an all-time high in terms of jobs, while North Dakota still trying to reach back to the pre-COVID days. Since you are celebrating the 50th anniversary, I thought I would go back even longer. So this is the job numbers from 1970 onwards. So back in 1970, both states had essentially about 160,000 people with jobs, but steady growth over the years, and both states in a long-term horizon, you can say has more than double in terms of the job over this time period. Little fluctuation in between, and of course, the oil boom led to that big job growth in North Dakota before scaling back somewhat in the more cautionary environment of drilling. But long-term growth shows solid condition, and hence, steadily and steadily, more people living in both states. Now turning to the housing market. We are seeing a housing recession in terms of fewer transactions, fewer home building activity, and the mortgage lending industry actually laying off workers. So there is a housing recession, and pending contract is clearly showing downward trend. The red line is essentially pre-COVID condition of January and February of 2020. All the data are seasonally adjusted to account for the normal seasonal variations. And what it shows is that we had a boom in the second half of 2020, and then 2021, very solid. But now in 2021, 2022, I should say, because of much higher mortgage rate, it is crippling the home sales activity. Now, your consumers are very happy. So this is not about home price collapse or foreclosure crisis. Your past clients are very happy. They work with you. I mean, you should go and shake their hands and congratulate them for purchasing home at a record low mortgage rates. The recession is not about homeowners or home prices. The housing recession is about fewer business transactions for people in the industry. But the prices are still rising. Again, a testament that your clients are very happy, content. And the price growth, the red line showing South Dakota has been stronger compared to North Dakota. Naturally, the job market is stronger in South Dakota in the past year. So South Dakota is seeing price growth of about 20% above 1 year ago, while North Dakota is seeing price growth of about 13%. I mean, still a very good number, but less strong than, say, many other parts of the country where the price growth has been in the 15, 16, 17% range. Home prices over the long run, and again, it's because of the 50th anniversary, it began to trigger thoughts in my mind. What was it like 50 years ago? 1970, do you know the median home price in 1970 was around $25,000? Then 1980, still less than 100. Only in 1990 did the home prices began to reach close to 100,000. But this shows that homeowners steadily build wealth. You don't believe me? Talk to your grandmother as to when she purchased her first home at what price, and you will be amazed. Furthermore, think about your grandchildren or future grandchildren, and they will chuckle at the home price that you are purchasing today, because in the future, you are looking at $1 million home in the Dakotas in the future, maybe in 15 years, maybe in 20 years, but the long-term path she is showing that home prices steadily rise over time. There may be some 1 or 2 year fluctuation, but over the long haul, it rises. And thank goodness we don't have those risky subprime lending to go wrong. So right now, recent home buyers all qualifying, meeting the ability to repay standards. Federal Reserve has been raising interest rates. Federal Reserve controls the red line, only the red line. And it is the interest rate not for you and me, but for the banking system. And they have been raising these interest rates. And the mortgage rate generally follows the red line sometimes, but not always. As you can see on the middle of the graph, what you see on the middle of the graph is the red line goes up, goes down, yet the blue line barely changes. So the mortgage rate do not have to change along with the Federal Reserve. But this time is different. Federal Reserve has been raising interest rate, and the mortgage rate reacted violently, rising, doubling from 3% of last year to now 6%. And what is the reasoning for that? Because the mortgage market is in essence saying Federal Reserve is not done. They will again raise interest rate later in the September, probably by large increment, 75 basis point, large chunk in September. Then again in November, I think it's after the midterm elections, then probably one more round in early 2023. So the mortgage market knows this and is trying to price this in. It also means the mortgage rate may have already topped. So 6% may be the new normal, maybe a little higher, a little lower, but no major changes from the 6% mortgage rate which is my best estimate about the future developments because it already priced in what the Federal Reserve will be doing. Now, because of the rising rates, some houses are taking longer to sell. In fact, when we looked at the data recently, we find that half of the homes do not require price concession, but other half of the home, they are doing some price concession in order to sign the contract. And when we compare with the days on the market, it shows that through price negotiation in the first week, maybe about 5% price negotiation. But if the home is sitting on the market for 1 month, then you are looking at about 8% price negotiation. But if it's 3 months or longer, then it is 11% or 12% price adjustment. So one has to list their price appropriately to find the buyers. Otherwise, it could sit on the market for a long period, and then you wind up reducing the price. So price the home according to the market, and we are in a changing market condition. Now, chart that you may have seen before, but let's update the numbers. The official number is the blue bar from the Federal Reserve, but that data is quite old, 2019. Federal Reserve has not updated the figure from 2019. So what I did was, I know that prices are rising strongly in South Dakota. I mean, also in North Dakota. So trying to adjust for price increases, what I'm finding is that for a typical homeowner, their wealth is around $320,000. While for a renter, it is infinitesimal, very small. So huge wealth gap or wealth building potential by holding onto real estate over a long period. So again, another testament about you buy a home in 1970, what has happened at 50 years later? You see a huge gain. So typical homeowner in North Dakota, South Dakota, I mean, they could easily be holding on to around $300,000 in wealth. Inventory level still remains very tight, which is meaning that home price decline potential is very minimal. We have home price decline when there is an oversupply. The middle of the graph shows oversupply and consequently foreclosure crisis, home prices collapse. But at this time, we still don't have enough inventory. And in fact, the inventory level is much lower than pre-COVID days. I know it's rising somewhat compared to last year, but compared to pre-COVID, it is still down. Consequently, don't worry about oversupply condition that can lead to price collapse. Consumers' view on the economy is not good. Consumers are saying economy stinks. Maybe they're reminded every day when they go to gas station or when they go to grocery store. So consumer sentiment index as measured by the University of Michigan remains very, very low. As related to the housing, recent Fannie Mae survey to a very simple question, is it a good time to buy? And you can see it's collapsing. Of course, higher mortgage rates is certainly a contributing factor to this decline. But I will also caution that sometimes a survey data on intent, people's intent to buy, do not necessarily match up with their actual behavior. Look at the housing market boom in 2021. Do we see a number of people saying it's a good time to buy? No, it remains steady, yet we know home sales increased tremendously. So when people see right time, like right mortgage rates or right property coming onto the market, they will take a chance. But what people say, it may not be something so serious. What people do has definitely an economic impact and a serious decision on their finances. Let me put housing surveys slightly different. Again, survey is survey and not actual action. But this is a survey by the New York Federal Reserve asking the question, not about is it a good time to buy, but more of a long-term question. Is buying a home a good financial investment? Furthermore, in this survey, they ask question about rents. Because we know people do not like higher mortgage rates, but people truly detest paying higher rents. So once you began asking questions about rent, what do you think is going to happen to rent? Where people said, well, I think the rents will rise 6%. And home prices rising 5%. So buy a home, you build wealth. You don't buy a home, you are suffering on higher rent, and then next year, higher rent, next year, again, higher rent. So once you pose this question, then you ask, is buying a home a good financial investment? And by a overwhelming margin, 73% against 6%, people say buying a home is a good financial investment. We just need more inventory. And hopefully, maybe the mortgage rate will come down. But at least, even if the mortgage rate do not go down, I think it's sort of maxing out currently. So it's all about job growth. So as long as we can get that job momentum to continue, then I think we will steadily build the new potential set of buyers ready to purchase in the upcoming months and upcoming years. So thank you very much for listening. And again, congratulations on your 50th anniversary of the meeting of the Dakotas. And I'm glad you are always doing it jointly, and best to you all. Thank you.